Hey everyone, welcome back to Corporate Decoder, the place where we turn confusing corporate reports into something you can actually understand. Today, we're diving into Apogee Enterprises' latest quarterly filing. Get ready because there are some twists and turns in this report that might make you feel like you're walking through a glass maze. It's before we start. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for even more details. Apogee, if you haven't heard of them, makes architectural glass, metal and surfaces. Think of big shiny buildings, they're often involved. This report covers their performance for the 3 months that ended in May. The big story, sales are up a bit but profits have taken a nosedive. We will decode exactly why to understand if this is hold your horses or sell all the glass kind of situation. Alright, let's get into the numbers, the heart of this filing. It can look scary, but it is really not. Starting with a quick look at the balance sheet, Apogee had about $32.8 million in cash. That sounds like crazy money, and it is, but it's actually down from about $41.4 million back in March, so they're holding less cash recently. Their total current assets, things like cash, accounts receivable, and inventory, are at around $447 million. That is just slightly more than at the beginning of the quarter. The company seems to have grown mostly its inventory with $11 million, but we will see why soon. Now for something with a direct impact, let's jump to the liability side where we see they have about $311 million in long-term debt. That's up from $285 million earlier in the year. Debt is not necessarily bad, but more of it usually indicates more risk. Alright, so how are they actually doing as a company? Let's find out where they were making money and let's scroll to the numbers regarding their operations to see. Sales increased of around 15 million total, from around 331 million to around 346 million. So a solid around 5% increase, not bad. However, their actual cost of sales increased by 40 million. This is a huge deal. Usually you want profits to catch up with revenue. The company sells more, yay. The cost of that sale increases way more, boo. As a direct result of the cost increases, operating income, that is the money they made before taxes and interest, crashes from 41 million to just under 7. That's a massive drop by almost 85%. All of this trickles down to their earnings per share, which is a popular metric to measure how well a company is doing. It goes from $1.42 to minus $0.3, meaning they lost money, a lot of it. So what happened? Well, the document immediately mentions the depreciation of the properties. Depreciation is basically the natural revenue lost over the wear and tear of its properties. In good news, it went up, but not very much, from around $10 million to around $12 million. The receivables, the money that it expects but it hasn't received yet, is actually down as well. So customers are paying back their debts on time. That's great, but its impact is not that big. Inventories have increased by 11 million from around 92 to $103 million. This could be problematic if the company has trouble selling the items. Inventory ties up capital and might become obsolete. They brought in much more debt than the previous period. They now have around 59 million from facilities against around 29. This means they need even higher profits in the future. The company mentions that it has over $1 billion in bond commitments. These types of surety, performance bonds or letters of credit are often required for construction projects. They act as insurance policies in case the company fails to deliver. Let's dig into which of the company's business lines actually contributed more to these results. The architectural metals section actually generated less sales this period by about 3%. On the other hand, one business segment that is doing great is performance surfaces, which makes those high performance coated materials for museum and other applications, almost doubled its sales. Architectural services also saw a positive almost 8% jump. However, all business lines have seen profits fall in the first quarter. Architectural metals saw an over 60% drop. Architectural glass came down over 30%. The only business line to actually grow its profit was, unsurprisingly, the performance surfaces, seeing over 40% profits growth. This kind of explains the inventory situation. All the business lines except the performance surfaces are actually not doing that hot. And performance surfaces does not make up enough of the business to cover for the drop. The report also mentions that it completed the acquisition of UW Solutions on November of last year. It spent $240 million total for what sounds like a materials business. A bit further, the company restructures its business operations under a plan called Project Fortify 24. The report is not explicit on what exactly that means, but restructuring and fortifying business operations doesn't sound like a good thing. Usually it means firing personnel on April. The company expanded its restructuring plan and expects charges between $24 to $26 million to drive cost efficiencies. We are starting to understand where all the profit went up, with a notable part is the termination benefits with a $6.7 million expense. That for sure means firing people. MTR from notable part is the termination benefits with a $6.7 million expense. That for sure means firing people, but see how much more they have gone to debt with the extra expenses. The company mentions using more of its revolving credit facilities this period. The company amended its credit agreement to increase senior credit facility. It's now committed to a $450 million revolving credit and $250 million term loan, all taken together with their previous expenses. Might mean that Apogee has gone to debt of around $500 million. Okay, let's step back. We've gone through the filings, now let's talk about what it means. Apogee experienced a tough quarter. There were indeed some turns in the glass maze. While revenue is up, the increased cost, the restructuring expenses, and the debt are really concerning. This could suggest underlying inefficiencies they have to fix, or poor market conditions in their field and the overall economy. Grant. On the other hand, they are working to fix this with the restructuring. This is not something that you would actually advise someone to buy since it shows concerning trends. Alright, that's our breakdown of Apogee Enterprises' latest filing. If you find this kind of decoder report straight to the point and value your time, hitting that like button really helps send a signal, and subscribe for more deep dives. Don't forget to check out the Discord channel in the description for a chat. Thanks for watching, see you next time.